Yes, good morning, everyone. It's certainly a very volatile environment. I think the LME made clear that in terms of margin requirements, everyone is pretty much up to date. But no, you're absolutely right. I think there was a relatively large short position on the LME. And I would argue that that short position was well in excess of what the LME can actually handle in terms of liquidity. And given these are physically backed contracts, also in terms of inventories that are actually in the warehouse. So as prices started to rally, the shorts effectively got squeezed. And given the size of those short positions, it became, over a couple of days, a very disorderly market, up to the point that the LME decided to shut the venue. I think they're trying various things now. They're trying to net off the longs versus the shorts. But look, I think when you're reading through the latest notice on the LME, I think they are not entirely clear, and you alluded to that, how it will all play out. They say, well, prices could effectively go up, but if you don't manage to net off all, if you don't manage to net off all of the positions, but they could also go down and reset it. That's why they have got an upward and downward limit. I think ultimately, to your point, there will be someone will be carrying losses from that positions. And yes, given the size of the positions, you're talking not about millions, but potentially about billions of dollars.
Michael, we've had markets that have fluctuated wildly in recent years. How does an exchange that is about a century and a half old get caught up in a situation like this where it can't settle a contract?
That is an interesting question. But look, I think when you're looking at the London Metals Exchange, we've had squeezes with increasing frequency. We had one on copper just after, in October last year, after LME week. We had a couple in zinc. And I think there's various issues that the LME has. To me, still one of the key issues is that you have got, firstly, no position limits. And the second issue is that you do have physically backed contracts with decreasing physical backing. Inventories have seen steady outflows of metals. And I think given the deficit we forecast for some of the base metals, that is unlikely to get any better. So it all comes down to the question whether the LME has adjusted sufficiently to what is a changing market environment or not. And I would say they have not. And I think that's reflected in the volatility that we do see at the moment.
Michael, where does this go? Should we be chasing these metals prices higher, or do you begin to think about fading?
No, this is an interesting question, I think, and we've said all along, look, even before the war set off, some of the base metals, because of decarbonization, because of climate change, actually have very strong fundamentals. Aluminum rallied well before the crisis set off. Copper was well supported. Nickel was also quite well supported. And that's how I would effectively look at that. From an investment perspective, over the next kind of 12 to 18 months, I just think that the outlook for some of those commodities are relatively good. Would I take a position in nickel at the moment? Maybe not. Would I take a position in aluminum? Probably, right? Because we have a very decent fundamental outlook. No supply growth coming through, but quite decent outlook for demand. So it's really a more nuanced view, I think, here. But generally, I would say the metals are a key beneficiary from energy independence. Through investment in renewables and in EVs, through the move towards net zero. And I think that is something that will play out over the next 5 to 10 years, not over the next 6 to 12 months, right?
Michael, we've got to wrap up with you. In a one-word answer, would you buy gold at $1,900 an ounce?
Absolutely. We are long gold here, yes.